Thank you for being with us today. I am Marian, and it's a pleasure to have Jamie here to discuss the markets and share insights, especially in light of the latest developments around Trump's tariffs, China retaliation, and everything in between.
Thank you, Marion. Pleasure to be here, and I can't wait to get stuck in.
What's happening now in the market is unprecedented. Could you give us a quick summary of what's been going on in the last couple of weeks?
Sure thing. Just unprecedented, like you say. Incredible times. I've been in the markets for many, many years, seen lots of different crises and that kind of thing. But this is truly quite something, especially with Donald Trump, of course, in the White House. If we look at that sort of answer in two sections, if you like. So obviously, firstly, tariffs, where we are now with tariffs, and then obviously how markets have reacted. With tariffs, obviously, they're a moving target, but presently we have 10% blanket tariffs on all imports into the US. Then we have 25% tariffs on steel and aluminium, and also on parts of the auto sector. And we have 25% tariffs on Mexican and Canadian goods, which are exempt or not exempt, sorry, from their free trade agreement. And then, of course, we have the massive, great 100% plus 145% tariffs on China imports into the US. So that's kind of where we are currently with tariffs. Market-wise, probably three things to look at there: volatility, currencies, and then stock markets. So volatility, been an incredible period. The VIX index, which is Wall Street's fear gauge, essentially, that has an average, a long-term average of around 17 to 18, and that basically spiked higher just after Liberation Day on April 2nd, April 3rd to 60. Just for your guide, say the pandemic, that spiked higher to 80, so 80. So we were up in those sort of realms of volatility, of uncertainty. We've now come back down to around 30 or so, just below. So we're still elevated. Anything above 20 is seen as elevated and certainly volatile for markets. Incredible times on the volatility front, and then obviously that's impacted financial markets. So for currencies, the dollar has been incredibly weak. We've seen massive selling in the dollar, probably its worst month since the GFC, so since 2008, 2009. And really that's down to a potential slowdown in the US, which is hanging over markets. But also then the wider question, which is really interesting for a lot of us in markets, just this question around US exceptionalism and whether that is fading away as people move, big investors move away from the US. So they're selling dollar assets and selling the dollars, essentially. Haven currencies, for example, like the yen and the Swiss franc, really do exceptionally well, of course, with their haven qualities, as I say, and they're essentially liquid reserve currencies with large surpluses, and that's what investors flock to in times of uncertainty. So we've seen that as well. And then for stock markets, wow, what can we say? An incredible roller coaster ride, really. Whiplash of price volatility and movements. We saw a big sell-off, of course, after Liberation Day on that Friday, April 4th, and then April 7th, the Monday, was incredible. Really, if you were watching markets then in the Asian session, we had US futures down double digits before the US Open. And we had, just stock markets tanking. It was a sort of classic capitulation day, is what we call it in markets. So we had forced liquidation in assets, very safe assets like treasuries, US treasuries, like gold, and like defensive stocks. So forced selling in those assets and real panic really on that Monday morning. I think the S&P 500, so the benchmark US index, that was down close to or around 20% from its highs. So that denotes basically a bear market, which was obviously grabbed a lot of headlines. And then since that or during that period, then we sort of bounced off that low with that liquidation selling. And then a couple of days later, of course, on April 9th, we had the announcement by President Trump that there would be a 90-day pause in these tariffs, but we would still get that 10% blanket tariff, if you like. And then we had what I called actually a melt up. A lot of people are calling it a melt up. So instead of a melt down in stocks, we had a melt up, huge bounce of double digits again in some markets. The biggest the record percentage gain, I think, in the S&P 500, and on the Nasdaq, the sort of tech-heavy index in the US, that had its second biggest gain, daily gain on record. So, yeah, incredible sort of movement, incredible volatility in stocks, in currencies, in all markets. And now we're sort of at that point, still listening to headlines, still trading off headlines, essentially. Yeah, exceptional times, as you say, unprecedented, and still probably a lot more to come.
Hey, Jamie, why do Trump's tariffs matter so much to the markets?
It's a great question. I think if we look at tariffs on a basic level, they're basically a tax on consumption. That's what they are essentially. And then that means they impact on the US consumer. The US consumer is a key driver of the US economy. And if tariffs impact the consumer, then potentially we get an economic slowdown. And if you think about tariffs again in two parts, so the inflation aspect and then the growth aspect, certainly in the US, inflation is expected to go higher, and that will impact on the consumer and on the economy. And then for the rest of the world, for inflation, potentially you get lower inflation. So you get disinflation in the rest of the world. For example, in the EU, if goods aren't going to the US, then they get sent to the EU. There's more goods there, so we get lower prices. So you get the opposite of the inflation factor potentially in the US. So there's that side of things, price pressures potentially in the US. And then you get the growth aspect. And that's been the big issue for markets. And this potential slowdown that we're seeing in the US, which then spreads to the rest of the world as well. I think odds of a recession at the start of, recently have been around 50-50 in the US, which is exceptionally high, really. That has probably been tempered recently with easing tensions potentially. But it's just this idea that we've had a growth slowdown because of these tariffs, and then inflation higher in the US. That kind of, just to touch upon briefly, is a sort of stagflation environment. So stagflation is basically stagnant growth on the one side, and then inflation, higher prices on the other. And that's really not a good mix for the economy in the US and the globe as well. So yeah, various factors in that. I should probably mention as well that factor around US exceptionalism that I've just mentioned as well. Tariffs have sort of brought that to a head, really, and we've probably seen peak US exceptionalism. So the US outperforming every other economy. That is probably now very much in doubt. And as I've said, whether we get the safe haven characteristics of the dollar are also being questioned, which again, is an incredible sort of shift in investor sentiment, in investor mind shift as well, really, where investors are moving out of the US in stocks, for example, and say European equities over the last couple of months have really outperformed the US. And that is just a symptom of basically tariffs and their impact.
In your opinion, what is the impact of Trump's tariffs on inflation and jobs?
I think in a way, tax on consumption, and that means inflation goes higher, prices go higher. In the US, certainly that is the case. And that is a problem for the Fed potentially going forward. And we'll probably touch upon that shortly. And then the rest of the world, really, as I've said, potentially lower prices. For example, the ECB meeting recently, President Lagarde mentioned that they're looking at inflation and inflation going lower than expected, which would mean more rate cuts, for example, in the Eurozone. So yes, a lot of potential impact on inflation on both sides, rising and falling in different parts of the world. And for jobs, certainly, if we get a slowdown, an economic slowdown, or potentially a recession as well, then that no doubt impacts jobs. And we'll be looking at some of the main US data like non-farm payrolls and other jobs data to see, how that feeds through. I would say it will probably take some time for the effects really to feed through. Everybody's expectant of watching data collapse, but it will probably take a few weeks at least to feed into the data. Remember, a lot of data is backward looking. GDP data is backward looking, so it doesn't take account really of what we've seen, in the last couple of weeks.
Do you think Trump's tariff plans might put extra pressure on the Fed when it comes to rate cuts or hikes?
Great question. And even, this is very, very topical at the moment because we've had President Trump, as I mentioned, sort of questioning Jerome Powell, the Fed chair, being too late in cutting rates and putting, a lot of pressure on him as a central banker and the Fed as a central bank. Probably a couple of things to note here. There's a lot of research out there which says there's a high correlation between an independent central bank and low and stable inflation. So, that is the primary thing that markets think about. So when politicians try and interfere in monetary policy or with the Fed, then it's really not a good look. And over the weekend and on Monday, we saw selling again of the dollar, which sort of is symptomatic of that sort of theme. For the Fed itself, we heard from Jerome Powell recently, actually, who markets were expecting him possibly to side with Trump and that narrative around possibly being more dovish and looking at rate cuts going forward. In fact, Jerome Powell, and this is probably what got Trump slightly annoyed, is that he basically said the dual mandate of the Fed, which is basically maximum employment and stable prices. He said that the current labor market in the US was fairly solid. So that wasn't a concern, but his concern was higher prices. He did expect a deteriorating labor market, but as I say, he sided more with the growth side of things. He sided more with the inflation side of things. That would probably mean rates staying on hold for longer as the Fed assesses the data. And as I say, that didn't really please Donald Trump too much.
And how will companies be impacted by these tariffs? How will the stock price be impacted?
Tariffs really, they weigh on two aspects, really: US firms and their profit margins, and then they weigh on US consumers and real incomes. And really, then potentially that erodes the US sort of exceptional return prospects that we've seen recently. That also potentially weighs on the dollar as well, because if US companies aren't doing so well, then the dollar will be impacted. But what we see for companies then is valuations being lowered. We also see then earnings revisions moved lower as well. And that is the primary sort of impact from tariffs on companies and US companies especially. Stock prices then, as I've said, valuations get lowered, earnings get revised down, then that will potentially impact their stock prices. I would say a caveat to that is the fact that we've been talking about recession, about a slowdown for some weeks now. So that's probably in the price in a lot of stocks. Some of the individual stocks and also the stock indices price already. And that kind of means there's a low bar if we get positive surprises. So if we get positive surprises from Donald Trump, which we've seen in the last so often in the last few days, then potentially we get a big bounce in stocks and in stock indices. And I would say, a lot of this uncertainty, when you're in it, it feels like it's never going to end. But these things do end generally. And we should take account of that. And certainly stock prices, if you remember, and if we always remember, are forward-looking and they look 6 months ahead plus. So yes, always bear that in mind, obviously, with companies and their outlook as well.
What impact have China's retaliatory moves had on its own economy?
Well, evidently, China's economy will be hit pretty hard with reciprocal tariffs. Probably as tariffs have got ratcheted up, into the sort of triple digits, 100 plus, then they're slightly less meaningful. I think that means we're getting towards the end game in tariffs when there's just this tit for tat increase in these reciprocal tariffs, and obviously 145% is unprecedented, really. So yeah, they could be slightly less meaningful going forward. I think for exporters that is definitely the case. And potentially they've already been likely substituted, some of these exporters anyway, if there are alternatives available. So in a way, there's less impact now. But of course, I think I've seen the figure of a 60% drop in US imports from China. So that's the sort of impact we're looking at on that front. And I know then there's all these logistics and shipping issues that we're going to get, and this shift in global shipping patterns, essentially, because of this shift now, because of tariffs. Just on the sort of GDP outlook, a lot of investment banks, a lot of economists obviously moving down their expectations for Chinese growth from, well, the official number is sort of 5%, but I know that now a lot of economists are looking at below 4% for GDP for this year. And we actually had a recent figure out of China, which was 5.4%. As I've said, that sort of backs up what I said earlier about this data being backward looking. But in that data, it's interesting, we did see essentially exports being brought forward, so front loading of exports, which was obvious ahead of these tariffs, for one thing. But then we've had this sort of masking with Chinese domestic policy. So we've had a lot of fiscal stimulus, and we've also had sort of consumption support, which is sort of helping the economy, the domestic economy. But it's whether, the big question is whether or how much of that we see going forward to shield the economy from, obviously, the tariffs, which are expected in some form.
How will the prolonged US-China trade conflict reshape their economies and growth prospects?
For the US, I've talked about the consumer being, the major driver of the US economy in recent years. And I think a good example of this is seen in retail sales that we saw recently out of the US. So we had the headline fairly solid, but then we had a slightly different number, the control group, which feeds into consumer spending and also GDP, and that was below expectations. And I think going forward, that points to GDP being pretty flat in the US, if not possibly negative in this quarter. And then in the next quarter, Q2, if we don't get a rebound, which is likely, then we could see a similar sort of very flat print in the US, which is, quite a shock for the global economy and certainly for the US economy. Just three things on that for the US economy and the consumer. I think you see a declining wealth effect because of the impact around the volatility in stock markets. You also see potentially the anticipation of squeezed spending power in consumers. And then thirdly, you probably see an expectation of a deterioration in the jobs market, and then that impacts consumer behavior going forward. So I think that's the impact of tariffs for the US. For the rest of the world, you mentioned, we talked about, or haven't talked about, supply chains, and potentially they get impacted, and supply chains get shifted to other parts of the world. And I think just one point on this, interestingly, in Vietnam, for example, which now has a 10% blanket tariff, but had kind of a 46% reciprocal tariff, which has been paused. We've seen shipping rates from Vietnam to US increase very sharply recently because Vietnam is essentially sort of filling that gap that Chinese imports were acting as, but now Vietnamese imports into US are taking advantage of that. So I think that's what you'll see generally, potentially going forward, as China imports into the US obviously disappear essentially, and other countries, take advantage of that.
What lessons can we learn from past trade disputes that might apply to the current situation? For example, the 2018 China-US tensions?
think it's a really interesting question because we always look back in history, don't we, to what's happened and then hopefully, learn from those lessons about what may happen going forward. In a way, we're sort of slightly different. We've got higher inflation, we've got higher tariffs, essentially, especially on China. So that is a sort of big difference. Those are two big differences. I guess from what we need to look at is the Fed, and the Fed's reaction function is what we call it in markets. So how they react to what's happening going forward. It's basically whether they look through this sort of one-time, what we call a one-time price shock because of tariffs. And in 2019, if we look back to then, interest rates were expected to go higher, but what we actually saw from tariffs is stock markets go lower. There was a tightening of financial conditions, and what the Fed did was basically cut rates because they looked or sided with the growth aspect and deteriorating labor markets rather than the inflation side of things. So slightly different from what we're hearing from Jay Powell, as we just talked about earlier, from 2019, but potentially, we need to take, I would say we need to take, we need to make sure we understand the reasoning for that potentially going forward with what happens in the months ahead.
So, Jamie, with all that we've discussed, what's your outlook on the next couple of months in the markets? Are you bullish or bearish?
That's a tough question. I could be bullish or bearish in the next 24 hours, and that might be accurate for the next few months. Then I was actually talking to a lot of friends in the markets and asking the same question. And they were very similar. Well, we can tell you in the next hour what we think, but that might change in the next, the next day or so. I think markets, we have to be diversified if we're investors. So we have to look at different asset classes. So we look at stocks, we look at, say, different currencies, we look at crypto potentially, because we don't want to put, all our eggs in one basket. I probably would say, and we've seen this over the last, recently, President Trump kind of has a backstop. When he's challenged, it seems he kind of blinks. Is I think what we can say. And I talked about this recently in some of the written pieces that we put out on the website, just about the pain point for Donald Trump. So when markets, what we call that in markets a Trump put. So it's an option, and it's an option really that allows investors to take losses when stock markets hit a certain point. And I think we've got that. We've now got that in markets, in the stock market, for example, in the S&P 500, with when markets went to sort of 4850, 4,835 was a low. Trump and Scott Bessent, the Treasury Secretary, they acted on that. And there may be a point in US Treasuries and in yields going too high, where, again, Trump backtracks, and that's what we've seen recently. And he steps in, and the market stops falling and potentially starts bouncing. So I think, there's a lot of opportunities in there. But again, it's so volatile that I would be mindful of, and I am mindful of, my position sizing and just having really, really solid risk management.
We know Trump's unpredictable, but do you think Trump is good for traders?
I think he's great for traders. I really do. As I've sort of mentioned, the volatility, is just exactly what traders generally want, right? We don't want flat markets. We don't want markets just trading sideways. What we want is volatility. It has been excessive, so and it's sometimes tough to trade, because when you think assets are overbought or oversold, they can carry on being overbought and oversold. And that is, a big lesson for me through history, is just because some of my technical indicators might indicate that I should be selling an asset or buying an asset, things can carry on and take out my stops quite easily. Yeah, he's definitely good for traders. Everybody's talking about the markets, I would say. Everybody's talking about Trump.
I have one last question for you. You can only answer one thing. What would you buy right now if you were given $1 million?
One asset class only?
Yeah, only one.
Wow. I'd probably buy one of the beaten up Magnificent Seven stocks, maybe Amazon. I think it's beaten up. Valuations are slightly better. It's now cheaper than it was. And I think their businesses, their cloud business, their AWS business, for example, is has a long way to go. So tough spot. But yes, let's just try Amazon or one of the other beaten up Magnificent Seven stocks.
Well noted. Well, thank you very much, Jamie. It was very, very interesting. I think we've learned a lot. Thank you very much, and have a good day. See you
Thank
soon.
you so much, Marion. Great to
Thank
speak to you.
you.